In 2013, a small group of men gathered in a conference room in Lower Manhattan. No cameras, no press releases, no public record. What they decided in that room would determine whether Bitcoin lived or died. And here's the thing most people don't know. The financial establishment didn't try to kill Bitcoin. They allowed it to survive, not because they believed in decentralization, not because they loved innovation, but because they saw something the rest of us missed. Bitcoin wasn't a threat to the old system, it was the perfect upgrade. This is the story of how Bitcoin became digital gold, not despite the powers that be, but because of them. Welcome to the Wealth Timeline, where money, power, and history intertwine to reveal how the world was truly built. Today, we're following the thread of one of the most misunderstood financial phenomena of the 21st century. Because the story you've been told about Bitcoin, the rebel currency, the people's money, isn't the whole truth. And the whole truth is far more fascinating. Let's rewind. October 2008. The global financial system is in freefall. Lehman Brothers has collapsed. Banks are being bailed out with taxpayer money. Trust in institutions is at an all-time low. And in the middle of this chaos, a pseudonymous figure named Satoshi Nakamoto publishes a 9-page white paper titled Bitcoin, a peer-to-peer electronic cash system. The timing wasn't an accident. The paper proposed something radical, a currency that didn't need banks, governments, or central authorities. A system where trust was replaced by code, where power was distributed across a network instead of concentrated in vaults. It was digital anarchy wrapped in elegant mathematics. And for the first few years, Bitcoin was exactly that, a fringe experiment used by cryptographers, libertarians, and people buying things they probably shouldn't on the dark web. But then something changed. The very institutions Bitcoin was designed to replace started paying attention. Not to destroy it, to claim it. So here asks the question, how did a tool meant to dismantle the financial empire become one of its most valuable assets? To understand how Bitcoin became digital gold, you need to understand what gold actually is, not as a metal, but as an idea. Gold has no intrinsic value. You can't eat it. You can't burn it for energy. Its industrial uses are minimal compared to its price. Gold is valuable because we agree it's valuable. For thousands of years, empires used gold as a store of wealth. The Romans stockpiled it, the Spanish conquered continents for it. The British Empire anchored its currency to it. But gold has a problem. It's heavy, hard to move, and increasingly controlled by central banks. By the 20th century, gold had become a prisoner of the system it once powered. Enter Bitcoin. When Satoshi designed Bitcoin, he borrowed gold's scarcity model. Only 21 million Bitcoin would ever exist. No government could print more. No central bank could manipulate supply. It was digital scarcity, something that had never existed before. And scarcity, as every empire in history knows, is the foundation of value. But here's where it gets interesting. Satoshi disappeared in 2011, just vanished. Left the project in the hands of developers and walked away. Some say he feared government retaliation. Others believe he was protecting Bitcoin from having a single point of failure, a leader who could be corrupted or controlled. But there's a third theory. What if Satoshi left because Bitcoin had already served its purpose? What if the real architects of Bitcoin's rise were only just getting started? By 2013, Bitcoin was no longer a niche experiment. Its price had climbed from pennies to over $100. Media outlets were covering it. Venture capitalists were sniffing around. And the financial establishment was watching. Now, conventional wisdom says Wall Street hated Bitcoin. That they saw it as a threat, that they lobbied governments to crush it. But the evidence tells a different story. In March 2013, the U.S. Treasury's Financial Crimes Enforcement Network, FinCEN, issued guidance on virtual currencies. Instead of banning Bitcoin, they legitimized it. They classified exchanges as money service businesses, bringing them into the regulatory fold. Translation: Bitcoin wasn't illegal. It just had to play by the rules. Then came the hearings. In November 2013, the U.S. Senate held hearings on virtual currencies. Bitcoin was front and center. Senators questioned regulators. The FBI discussed risks. And then something unexpected happened. Federal Reserve Chair Ben Bernanke sent a letter to the committee. In it, he acknowledged that virtual currencies may hold long-term promise, not condemnation, promise. Why would the architect of central banking endorse a system designed to replace central banking? Because they understood something the Bitcoin purists didn't. Bitcoin didn't threaten the financial system, it completed it. Think about what traditional finance needed: a digital asset that couldn't be printed, couldn't be controlled by any single nation, and could move across borders instantly. They needed digital gold, and Bitcoin gave it to them. But this power came with a cost. By 2017, Bitcoin was no longer the people's currency. It had become something else, a speculative asset. The narrative shifted. Bitcoin wasn't for buying coffee anymore. It was for holding, for storing value, for hedging against inflation. It was, quite literally, becoming digital gold, and Wall Street was leading the charge. In December 2017, the Chicago Mercantile Exchange and the Chicago Board Options Exchange launched Bitcoin futures. For the first time, institutional investors could bet on Bitcoin's price without ever touching the underlying asset. This was the moment. Futures markets don't just track assets, they control them. They allow large players to hedge, manipulate, and profit from volatility. They turn wild speculation into structured finance. Bitcoin had been domesticated. But here's the twist: the Bitcoin community celebrated this. They saw institutional adoption as validation, as proof that Bitcoin had made it. What they didn't see was the trap. Because once Bitcoin became an asset class, it stopped being a currency. It became something you held, not something you used. And the moment it became something you held, it needed the very infrastructure it was designed to replace: banks, custodians, regulators, and exchanges. Bitcoin didn't overthrow the empire, it joined it. But the real question is, was this always the plan? Let's talk about who won. Not the early adopters who believed in Bitcoin's revolutionary potential. Most of them cashed out or watched their holdings become too valuable to spend. Not the libertarians who dreamed of a stateless currency. They watched Bitcoin get absorbed into the exact system they wanted to escape. The winners were the institutions. Hedge funds bought Bitcoin as a portfolio diversifier. Billionaires like Paul Tudor Jones called it the fastest horse in the race against inflation. Tesla put $1.5 billion into Bitcoin. MicroStrategy turned its entire corporate strategy into a Bitcoin accumulation play. And then came the ETFs. In January 2024, the U.S. Securities and Exchange Commission approved spot Bitcoin ETFs. BlackRock, Fidelity, and other giants launched funds that allowed everyday investors to buy Bitcoin exposure through their retirement accounts. Bitcoin was now a product, and products, unlike revolutions, are easy to control. But here's what's fascinating: Bitcoin's price didn't collapse under institutional control. It soared, because the institutions understood something fundamental: scarcity plus demand equals value. And by positioning Bitcoin as digital gold, they created a narrative that drove demand through the roof. Gold doesn't need to be useful, it just needs to be scarce and trusted. Bitcoin, now backed by the same financial machinery that backs gold, became exactly that. The system didn't kill Bitcoin, it claimed it. So where does that leave us today? Bitcoin is worth over $1 trillion. It's held by governments, corporations, and central banks. El Salvador made it legal tender. Pension funds have exposure to it. And yet, almost no one uses it to buy anything. Why? Because Bitcoin was never going to replace money. It was always going to replace gold. Think about the history. In 1971, President Nixon ended the gold standard. The dollar was no longer backed by gold, it was backed by trust in the US government. For 50 years, that system worked. But trust is fragile. Inflation erodes it, debt weakens it. Geopolitical instability shatters it, and so the world needed a new form of gold. One that couldn't be seized by governments, one that could move at the speed of the internet. One that was borderless, censorship-resistant, and mathematically scarce. Bitcoin checked every box. But here's the catch: for Bitcoin to become digital gold, it had to be accepted by the powers that be. And it was, not because they loved decentralization, but because they saw an opportunity. Central banks are now exploring digital currencies. Stablecoins are proliferating. The IMF is researching blockchain-based settlement systems. The empire didn't fall, it evolved, and Bitcoin was the prototype. So here's the final revelation: Bitcoin's greatest achievement wasn't escaping the system. It was teaching the system how to upgrade itself. Let's bring it all together. 3 takeaways. First, Bitcoin succeeded not because it destroyed the financial system, but because it offered the system something it desperately needed, a digital store of value that couldn't be printed into oblivion. Second, the institutions that embraced Bitcoin didn't betray its ideals. They revealed what those ideals actually served: scarcity, trust, power, the same forces that built empires for millennia. Third, the story of Bitcoin isn't over. It's a chapter in a much longer story about how wealth and power adapt to survive. Today it's Bitcoin, tomorrow it might be something else. But the pattern remains the same. The tools change, the empire endures. So was Bitcoin a revolution? Yes, but not the one we thought. It wasn't a revolution against the system, it was a revolution within it. And maybe that's the most important lesson of all. Because in the world of wealth and power, history never ends, it just changes hands. If you enjoyed uncovering this hidden chapter of history, don't forget to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next story might just rewrite what you thought you knew about power. Thanks for watching.